This lesson is on the income statement. This is a very general, typical income statement for a company, a very basic one. In our income statement, we'll start off with our sales amount. This is a positive figure in our income statement. The sales amount would be the total amount earned for selling goods. It is important to take your balance, add and subtract any adjustments that have occurred and not been recorded, and then also subtract your debtors allowances and total that into your sales block. Cost of sales is a negative in your income statement. It would be put into brackets. Again, it would be your balance plus or minus any adjustments that have not been recorded. You would then take your sales amount minus your cost of sales to get your gross profit figure, which would go in this block. We then move on to operating incomes. These are any other incomes that have happened during the year for the company. An example is rent income. You would list all the incomes relevant under each other with their amounts and then total them to the operating incomes. And this would be a positive figure because incomes is money coming in. We then have operating expenses. This is a negative figure in the income statement because it is money going out. There would be, again, a list of relevant expenses which are totaled to the operating expenses account or amount block here. Examples of operating expenses that are more relevant and new to companies are directors' fees and audit fees, which we will get to later. We then take our gross profit, we add operating incomes, we minus operating expenses, and we get an amount which becomes our operating profit. Then we have interest income, which has its own note. Sometimes this note is not given and we just have to work in a bracket over here. Interest income is any interest earned on an investment where the business earns money from this investment. Generally, interest on a fixed deposit is the most common one. This is a positive thing for the business and therefore is added to operating profit and totaled into profit before interest expense. Interest expense also has its own note. This is any interest earned on any debt the business has, for example, interest on loan. This is a negative figure. It is put into brackets, subtracted from our profit before interest expense, and then we will make up the net profit before tax. Then we have income tax. This is a certain percentage of my net profit before tax, generally around 28 to 30%. But this percentage will be given. You would say 28 over 100 or 30 over 100, depending on the percentage, multiply by my net profit before tax. This will give you your amount for income tax. You would say net profit before tax minus income tax gives you net profit after tax. It is a negative because it is money that we have to pay to SARS. With this income statement, they can not give you certain information and you would have to use your understanding of the plus, minus, and equal signs in order to monkey puzzle the figures. We then move on to some important adjustments that are relevant to companies and which are probably new for grade 11. The first being directors' fees. This is the salaries that are paid to the directors. Directors are employees of the business which manage the business. They are not the owners of the business. They are just the managers. The owners of the business are the shareholders. We then move on to provision for bad debts adjustment. This amount is the change in provision for bad debts from last year's figure to this year's figure. Once you've calculated your new provision for bad debts, you would find the difference in this figure to last year's figure. If it was an increase, if last year increased to this year's figure, then it would be an expense. Your provision for bad debts adjustment would go into operating expenses because we are expecting more bad debts. We are preparing for more outflows. Therefore, we would have an expense as our provision for bad debts adjustment. If our provision for bad debts decreased, this is a good thing. We're expecting more of our debtors to actually pay us and to not have as high of bad debts. Therefore, it would become an income. Then we move on to trading stock deficit or trading stock surplus. This is when we compare our actual trading stock amount to the amount that we have recorded in our books. This is generally after we've done a stock take at the end of the year, and we compare it to the amount we have recorded in trading stock in our books. If the amount in our books is higher than the stock count, it means we actually have lower stock than we have recorded. Then we'll have a trading stock deficit. The amount would be the difference between the two. If we have a higher amount of actual trading stock to the amount we have in our books, we would have a trading stock surplus, and the amount would be the difference. Trading stock deficit is an expense, and trading stock surplus is an income. Audit fees. These are fees that we pay to external auditors. These are people that come in to check that our company is flowing ethically and that there are no errors in our recording and reporting. Then we move on to depreciation. This is something that was covered in grade 11. It is the amount that a fixed asset has decreased in value due to wear and tear. This amount is an expense and is also recorded in our fixed assets note. The last adjustment is income tax. It is a certain percentage of net profit that is paid to SARS. It is generally around 28 to 30%. Like I explained, you would take your net profit before tax, times it by 28%, and get an amount, and that would be your income tax. That amount should be paid to SARS.